and welcome to the Invest with Carl podcast. I'm Jamie Eppenberg, your host and a member of the Carl team. Today, we are meeting again with the members of the managers of the investment strategy, Carl investment strategy, El Capitan. That's Sergio Nozal and Daniel Requejo, which he'll pronounce his name appropriately in just a moment. But we're going to be talking about the risk strategies that are built into El Capitan, or intended risk strategies, as I have to say. And Sergio will talk to us about current market trends and what he's seeing and what he thinks about them and how it may or may not impact El Capitan. And maybe it'll impact how it reacts to risk. As a reminder, Sergio Nozal started his financial markets career in 2000, and since 2004, he is focused on U.S. markets through spread trading on equities, stocks, ETFs, options. And in 2011, he started to manage private capital for investors. And currently, he is an investment advisor and manages independent accounts for investors, as well as coaches students on portfolio management. So maybe we'll also hear about, the benefits of having hedge funds in your portfolio. Daniel Requejo, he's been a computer engineer for almost 30 years. So he's big and good on the tech. He started trading in 2001 and started with Shark Capital in 2010, 11. These gentlemen got together. He was actually taking a course where Sergio was the professor, and they hit it off and connected, and now they together manage El Capitan. So welcome, gentlemen, to the show.
Thank you. Hi, thank you for having us here.
Yeah. So, Daniel, I think we'll start on risk with El Capitan. And I'll just give a reminder to our listeners. We had a risk series last year that I actually didn't do too many episodes in the last half of 2021 or even the first half of 2022. So we're kind of picking that back up a bit and beginning to re-discuss the risk series. The fundamentals we had been discussing were that risk is a critical part of any hedge fund, of really any investment that you might be looking at. And it's an important part of Carl due diligence. We look a lot at funds' risk strategies and how they intend to manage risk, because a strategy's ability to control risk significantly decreases or can even avoid downturns. And if an investment can avoid downturns, it overall would be higher than the market, because the market is generally adjusting. It doesn't necessarily exit during the downturn. So if you just stay in the market long term, as many folks do for retirement and other purposes, you just ride out the downturns, right? Maybe you invest more during them, but you're riding them out. There are other ways to manage that risk. So with that as the backdrop, Daniel, what does risk mean to El Capitan? Like, what do you view as risk to the strategy?
So for us, controlling the risk is more of the more important things in our strategy. So in fact, our strategy has embedded a tail risk system inside of the system where we're trying to control the risk. So yeah, it's one of our main concerns is how to protect the capital when the market is down, when there is a crash, or when there is a retracement, a big retracement, in order to keep the volatility low and for the peace of mind of our investors.
So why don't you give us just a quick overview of El Capitan, because some of our investors might not remember. I know you just said tail risk and you're working to manage that consistently within the investment. What is that? What is the overall arch of El Capitan? And then maybe we can fit the tail risk into it.
Yeah, El Capitan tried to capture alpha during the market, when the market has increasing or when the market is going down. So it's like a swing trading system based on the different indicators and different data from the market. But the more important thing for us is controlling the risk. So what we did is embed a tail risk system inside of the original system. That means that using breadth indicators, that is giving us how the structure of the market is at this moment, we can more or less get in with very accurate, let's say, statistics that the market is going down. And this is how we protect the capital. As you can see this year that the market has been going down more than 20%. In our case, the Capitan never went down more than 6%. So that means that we are keeping the risks under control. That is our objective and our goal.
How much of a factor do you see risk management within the strategy playing in its overall growth? Like, how important do you find it, and how much focus and effort do you put on it from that technical perspective, given it's a quantitative strategy?
For the technical point of view, at the very beginning, we have the base algorithm. That was a very good algorithm in terms of return. But the problem that we found out is that the big returns are coming with big drawdowns. So then we spent together thinking about how to control the risks. And from a technical point of view, we find out, as I mentioned before, that the credit indicators is the best way to find out what the market is doing. And the good thing is that not only is protecting the system, sometimes it's even giving us some alpha when the market is going down. So we focus on have a very, very good system, and we were focusing our back testing to be sure that everything is working when we have another cases of crises like 2008 and 2001.
Yeah, and that's one of the questions we asked. Was there a time when the risk system? Well, actually, I'll ask first. Have you guys changed the risk system a lot, or did you kind of, when you began to tool the risk system, did you kind of find the factors that you liked right away, or is it a constant retooling within the risk system?
The risk system is returning, so based on new things that are happening in the market, every time that a new event is happening, if the risks system is not working in the way that we were expecting, we're looking for ways to improve the risk system.
Okay, so it's in a constant innovation mode, because we have it's been a pretty different, we've had different types of markets for 2 or 3 years here with the retail investors coming in. Something that Carl looks for and our investors look for as well. Are you adapting to the innovation of the market? So it sounds like you guys are looking at that and retooling as necessary. So the question is, was there a time when the risk system really kicked in and you guys were very pleased with the results? So obviously recently sounds good. 6% to a 20%.
The best example was in 2020 when the market went down, I think 40%. Our system only went down 5%. So that was the best example in our recent events.
Okay, great. Do you have a perspective if someone has been investing in traditional stocks, right, that don't necessarily have a tail hedge built into them? The investor would have to take their own action. What's your perspective of investing in traditional stocks and bonds and having the opportunity to move over to a quantitative hedge fund? What do you think are the benefits or detriments to those models?
So my view of investing in traditional bonds or traditional stock, buy and hold, and keep it, let's say, part of the investment in bonds and part of the investment in stocks, is not bad. But the problem is that you are moving with the market. So you don't make any decision. The market is deciding by you. So if it is a moment that the market is going down, you can see your savings for your life decreasing 40, 50, or even 80%, and that happened in 2008. So sometimes we saw in the market that the bonds compensate a little bit the losses in the stock market, but as we can see this year, this is not happening. So it's not working bonds and it's not working stocks. So you need to have a risk control based on another things going short or other things, other way you cannot protect your investment, and you are being navigated by the market, not by yourself.
Right. And I think for some of our investors, it's actually helpful to have someone else looking at the risk for them. And obviously, given your background, you've been doing this for many years. And even you guys saw large drawdowns in the investment when you started and you had to install, right, the risk system. So I will mention that I think having a professional manager looking at the risk side for an investor who's not looking at this every day is one of the benefits of hedge funds, right? So you guys look at this every single day, right? This is what you do. So
I think the job of a manager is risk control. So otherwise it doesn't make sense. So what you need to do is when the market is going down, be sure that the volatility is under control and you are remove all of this stressful from the investors.
Yeah. So I think a lot of our investors enjoy having a pro, making sure that they're looking at this every single day. Which is a good transition. You talked about the market, and if you're in just stocks and bonds in general, you are running with the market. So maybe we turn over to Sergio here and ask. Sergio, I mean, the headlines I've read over the past week or two is like, maybe the inflation's over. It's done. It's ended. What are you seeing going on these days?
Yeah, well, I think nobody knows, but probably we have seen the peak. I think is probably, but I think the Federal Reserve is very optimistic with the future of inflation. I think people think it's going to get lower quicker than the reality is going to be. So I think we are going to stay in a high inflation period for few years. I think we are changing the scenario in the economy. So we are not going back to a low inflation target of 2% probably in few years. So that's my expectation about inflation. Means, yeah, sorry.
No.
And that correlates with the interest rate cycle that we are involved. That, for example, today is a big day with the FOMC meeting that we're expecting a raise of another 75 basic points or 100 points. Nobody knows, but I think we have ahead of us more increase of rates. We should reach around 5-6% at least. I think is going to take until next year.
Until next year. Yeah. I think a lot of investors have your same perspective. It's certainly not over yet, although I love the positive outlook of the headlines. I don't think that's the case. I will let our investors know it is September 21st, 2022. So if you're taking a look at when we're doing this, we'll see how well we do. I also will mention that we are not giving investment advice. These are personal opinions of myself and or the investors. We, do not intend for anyone to take our advice and take action on them. You have to consider your own portfolio and what's happening in your personal investments. So Sergio, with that, we also, Daniel and I talked very briefly there about bonds, and the bond market hasn't really proved in the past year or 18 months to be someplace you can go and hide for a little while. So what do you think about that bond market and what are investor options?
Yeah, well, the bond market is going to keep going down until the expectation of the the end of the cycle of interest rates stops. What I mean is if the Federal Reserve is going to keep increasing rates for a few months, if that is the expectation, probably the bonds are going to suffer for a few months more.
Absolutely.
We can have, of course, like the market can have some kind of rebounds, but I think the most of the people say this bond market is very oversold. It has to stop, but probably is not going to stop in a short time. So for the people is invested in this kind of traditional stock bonds, I will say take care of your risk because this has not ended yet.
What do you have? I don't know if you look at investors. What do you see investors doing? I mean, obviously, we would say hedge funds are a great place to look because you can at least get that risk professionally managed, having some, managers like yourself taking a look and doing their own hedge, their own tail risk management.
Yeah.
Do you see investors doing anything other than hedge funds or other alternatives?
Well, if my opinion is for the people that doesn't have some kind of professional experience investing in the market is not the best place to be now. Now
Right.
all the assets are going down. There is no kind of safe place. Even cash is not the way because the inflation is taking away your power by power. So now the only if you don't want to lose against inflation and want your investment and savings to be protected, you have to be with a professional. Right now, shorting the market is an option. Is the way we are doing now.
Right.
So there is no other. I mean, if you want to beat this market, you have to be short right now.
So I'm going to bring the two of you together a little bit here. I think a lot of investors are viewing the market similar to you, Sergio, that this is going to go on for a little while, but certainly into 2023. And shorting the market is absolutely an option. And hedge funds are a primary method of getting that done, having a space where you can get that done. And now I just will mention with Carl, if you are an accredited investor, you can do that for as low as $20,000. So, the barriers to entry for hedge funds are significantly different on the Carl platform. So you can get in and protect however much of your portfolio that's right for you with whichever investment you'd like. So obviously hedge funds are a place to go. You guys are professionally managing risk. How do you manage the end? So, Daniel, you talked about having the risk system, and then you have the system that's working during a bull market, during that big alpha, I'll call it time. How do you project, or how does the system project, like when is the end and when do we make the switch? How does that work?
It's a tricky question. It's not easy.
It is.
So basically the system is reading the market every day. So then you can see changes. The system is 100% automatic. So we are not making any decision in our own. So then as soon as the system is seeing that the market is changing, it need to happen different things. And all of these different things is like, let's say, a door that is open. So when all the doors are open, then we go up. If one of the doors isn't open, then we need to stay in cash, or then we need to invest a low amount. So that the idea is to having like different doors until everything is not green, we cannot go. But this is giving us the system by reading the market, reading how all the various indicators or what is telling us how many issues are going up, are going down, the volume, all of these things.
And what do you think about investors? I mean, this is a quantitative investment, so I imagine you're taking into account quite a few factors in order to make those decisions. What do you think about the difference between someone who's working with, not to put you on the spot, but just a Sergio, who like they're looking for Sergio to assess the market and make decisions for them, versus a quantitative investment that has all the algorithms and all of that has been built in? And you can improve on my very simple technical language, but what do you think about that difference?
The main difference is that we are doing the same thing again and again. So we are making our decisions in a very binary way. It is yes or no. But when you are making a decision by yourself, sometimes you have this suggestion or personal thinking that you cannot be sure that you did the same thing in the same scenario. I think this is the big difference, because you are making a decision by yourself, but you are not having the same thoughts every day, the same mood every day. So a lot of things can affect your emotion, feelings, and the way that you are acting in the market. So the best way is to remove all the feelings and act like a robot. For a person, it's very difficult, but for something that is called, this is 0 or 1. No, there are no other option.
Right. So to help our investors or listeners, then it is that you guys have basically built the rules outside of a bull or bear market, like outside of a fear situation, or outside of a, hey, it's rainbows and puppy dogs, it's raining money situation. We're not. El Capitan doesn't mean we're all dependent on Sergio's projection here of when it will change, right? So how do you know how many variables you guys take into account? It's probably more than a human can really calculate, right?
To be honest, it's not too many. It's less than 100 and more than 30. But it's not something that you can be managing and making decision on that, because you need to have
every day.
You have prepared exactly. We need to see every day. We have automatic system that they're getting all the data and running the show and telling us what's going on.
Yeah, I think 30 is a lot. I think a human being trying to assess 30 variables every day would be quite a bit.
Yeah, I think more than 7, 9 is going to be difficult to manage.
Exactly. Oh, you know the numbers. Yeah. All right, guys. I will ask anything else you'd like to chat about on the risk of the system or the markets upcoming. I think we've kind of covered most of it, but anything missing?
Yeah, I would like just to say to the people that is hearing us that the best way to show how risk how manage the risk is just seeing our performance this year. This is a complicated year, a difficult year for the most of investors. El Capitan is doing greatly. Is doing his job, that is to protect the investors' capital in contraction market. Right now, our yearly performance is about flat. Is minus 2%, something like that. So we are, protecting the investors' capital until these markets ends and start to go up. It could be next month or could be in 6 months. We don't know.
Right.
The
But at least
will tell us.
Yeah, the system will tell us. That's exactly right. Without human bias. So yeah, I think it's very important to many investors. As we've said, if you can avoid a downturn, then overall the alpha in your portfolio, it grows because you don't have to come back from the deficit. So definitely take your words to heart, Sergio. We encourage our investors to take a look at El Capitan and take a look at how it might fit in your portfolio. Obviously, these gentlemen are not only looking to grow your capital, but protect it in markets like we have today. And it's an alternative to other options out there that just aren't working the same as they used to. Gentlemen, Daniel, Sergio, very nice chatting with you today. Thank you so much for joining us. Listeners, thank you for joining us.
Thank you very much.
Yes. We'll see you next time. Bye-bye now.
Thank you. Thank you very much.
Bye.
Thank you.
Thank you for listening to the Invest with Carl podcast. The views shared on this podcast do not necessarily reflect the views of Carl. This podcast is intended for informational purposes only and is not intended to constitute and should not be deemed to be an offer to sell or a solicitation of an offer to buy any security or investment, financial advisory, legal, tax, accounting, or other professional advice. Carl funds are currently available to accredited investors with a minimum investment of $20,000. To learn more about Carl and to download the Carl app, go to investwithcarl.com.